This is Bloomberg Technology. I'm Taylor Riggs in for Emily Chang. Lots of big stories for you coming up in the next 40 minutes. The first big one we're watching, it is all about Tesla. Just today, Elon Musk coming out and saying that Tesla is on the verge of developing technology to render its vehicles fully capable of driving themselves. It's a claim that he's made for years, but, well, he's been unable to achieve them up until this point. Here to discuss all of this and all things Tesla is Joe Osha. He's an analyst from JMP Securities. Joe, it's always great to have you on the program, and I'm curious, with some of the news today about fully autonomous driving, how realistic do you think it is for Tesla to be there in the coming years?
Well, it's interesting, and thank you for having me on. If you look at what Elon has said today, he says that they should have, quote unquote, the basic functionality available by the end of the year. That's fine, and I think it's possible, but it's a long way from there to actually deploying full autonomy on public roads, and I think they're still several years away from that.
Joe, diving down into some of those comments, Elon Musk said that level 5 autonomy, it presents no fundamental challenges at this point. Through your research on this, are there no fundamental challenges? Are the challenges around technology? Is it around regulation, implementation of this on the highways? What do you see as the fundamental challenges to this?
Well, it's interesting. There's, sometimes one might think there's sort of a bright line between, say, ADAS level 3 and ADAS level 5, which describes the different levels. And there's not. It's just an increasing level of functionality. So it's certainly true. Tesla has a couple of things. They have a very, very powerful onboard compute platform in the new Teslas that ought to be able to handle quite a bit. They've gotten very, very good at ingesting mapping data, camera data. So they have all of the pieces. And to that extent, I think it's reasonable to say that you're going to get there. The challenge is what we like to call edge cases, right? The one case in 100 or 200 or 500 where things go wrong. And you can't have that happen in a car that's driving itself. So I don't think it's about the basic technology as much as it is about the robustness of it and getting to the point where it can be safely deployed on public roads.
Joe, is there any competitors at this point who are getting there faster than Tesla when it comes to autonomous driving?
Well, that's really interesting because you've had some very, very highly funded efforts. You've had Cruise Automation, which is owned by General Motors. You've had Waymo, which is owned by Google. Most recently, you had Zoox, which was an independent startup, which has been bought by Amazon. So there have been some very, very highly funded efforts out there, but no one has really made as much headway as Tesla on public roads. And I think that's because Tesla has been so effective at using its network of vehicles and integrating that with camera data collection and real world data and so forth to really drive forward. So it is kind of remarkable, given the amount of money that Cruise and Waymo in particular have spent, that they don't have nearly as much to show for it as Tesla does, at least yet.
And Joe, something else remarkable underway is just the massive rally that we've had in the share price. One of the best things I love about getting you on this program, and we spoke, 6-9 months ago or so, and I think that you were a little bit more bearish on the stock, and you are the first to admit that when the facts change, you change. What has made you change? What was that pivotal moment as you raise it now to a $1,500 price target? What was that inflection point for you to now perhaps look at Tesla in a different light?
Certainly. Well, I think the most important thing for any analyst is to always be looking at what's happening out there, always be willing to admit that you might be wrong, and always try and look at the data in an unbiased way. So as you point out, I was on the wrong side of things. What really got me thinking was the combination of two things. First, it was the fact that I look around and I still, with the possible exception of Volkswagen, don't see anyone else out there that can compete with Tesla. And the second thing I see, and we've seen this in other stocks, you look at what solar developers are doing, I think is a growing realization that transportation and power production and so forth, really does have to decarbonize over the next decade or two. And so I sat down and I looked at Tesla and I said, okay, realistically, could this be a $100 billion company? Could we be sitting here having the same conversation, Taylor, in 2025 with Tesla shipping 3 million units? And if so, does that make the stock a good investment now? And if I believe that, which I do, then I can argue that the stock should be worth $1,500, which I didn't.
What is your outlook for 2020 profit for this company?
Oh, I think it's difficult to say. I expect them to break even or, come roughly close to break even this year. And then I expect them to be solidly back into profitability for the remainder of the year. It's quite hard to judge, to be honest. And I will also point out that I'm valuing, when I look at multiples, I typically look at 2021 because, this has been such a disrupted year. But I expect the company to come out of this year solidly profitable and be probably close to break even this quarter, give or take.
And some of that optimism, I think, that's being reflected was the optimism we saw in the second quarter deliveries coming ahead of expected, despite some concerns about consumer demand with the pandemic, despite some of the factory shutdowns that you had over in Shanghai and in the U.S. Are you surprised at the rate of their deliveries?
I was, yeah, and the street was surprised as well. And it's just one quarter, but that should be the sort of thing that makes one think about longer term estimates, right? The joke goes that the long term is just a series of short term outcomes. And so if you look at the fact that they were able to deliver 90,000 units during arguably, the most challenging quarter imaginable, I think that does tell you something about the company's ability to be successful in a less challenging environment.
Well, thank you, as always, for telling us something and our viewers something insightful. Joe Osha, analyst at JMP Securities, thank you, as always, for joining. And coming up, it is a family of Black YouTubers say that their content got removed from YouTube, the Kids app, without an explanation. We'll have the details next. This is Bloomberg. After having his family's channel kicked off of YouTube Kids without any explanation, video blogger Ziri Zante is questioning the platform's treatment of Black creators. For more on this story, I want to bring in Bloomberg's Lucas Shaw. Lucas, this was one incident, though, but it might actually give us some pretty big insight into what's going on at YouTube Kids. Tell us a little bit about what you learned in this story.
It's funny because exactly what happened is not entirely clear, and that sort of says everything you need to know about the opacity surrounding what videos are and are not okay for kids, and how the algorithm works. YouTube has its main app, and then it has its Kids app. And the Zante family, they're not complaining that they're not on regular YouTube. They're upset that their videos disappeared from YouTube Kids. Now, their videos and their channel disappeared around the time that YouTube was taking down a whole bunch of channels because there had been a series of scandals about inappropriate programming within the YouTube Kids app, and they were trying to make sure it was totally safe. And in the process of taking down all those channels, they clearly took down some channels that maybe didn't need to be taken down out of excessive precaution. Some of those channels are now upset, and in particular, those led by Black families, sort of wondering, why does it feel like you're singling us out when we look in YouTube Kids? We really don't see sufficient representation.
And Lucas, that's the key, right? If they are indeed being singled out, what is YouTube saying to some of that criticism?
YouTube says it's not discriminating in any intentional way. It is like so many media companies trying to walk a very fine line right now, while making clear that they feel at least that they have not taken any intentionally racist or discriminatory steps, while acknowledging that they do have a lot of work to do when it comes to representation. I think YouTube feels like some of this might be a little unfair because YouTube has been perhaps better for kind of elevating certain voices that the mainstream media was not. And yet, if you look at a lot of the biggest stars on YouTube and within YouTube Kids, it tends to be very white and very male, much like the rest of media.
And Lucas, I think you bring up a big point that there is a difference between YouTube and some of the changes going on within YouTube Kids. What is that platform, YouTube Kids, undergoing, the changes they've made, some of the controversies that they've been involved in that have now gotten us up to this point?
Yeah, I mean, there have been complaints that YouTube Kids did not have suitable programming for children. But perhaps the biggest issue is that YouTube has historically not done a good enough job channeling people under the age of 13 from regular YouTube to YouTube Kids. You know, YouTube is the most popular video service in the world for all people, and that really includes children. I think there are a lot of families that use YouTube as the de facto babysitter, but it's not supposed to be that. YouTube is supposed to be for people over the age of 13. And so over the past few years, YouTube has taken a lot of steps to try to drive more young children to YouTube Kids. That's with marketing. That's now funding original programming, while also trying to make sure it's a safe environment, because people have uncovered all sorts of inappropriate videos within YouTube Kids, some involving suicide, some involving conspiracies. And so after those scandals, YouTube has kind of gone through a series of changes. There was also the matter last year with the Federal Trade Commission over children's privacy and collecting data. So this has been sort of a constant headache for YouTube, and one that they continue to work on.
And Lucas, you bring us a unique perspective because you're based in LA. So you have been covering in this moment of social change when we are talking about increasing diversity and real change that comes along with more equality. Black creators, Black entertainers. What are you hearing in LA from some of the more diverse voices about if this is the talk moment, or something bigger as we can really start to actually walk the walk moment here?
I think people are cautiously optimistic. You know, there have been a lot of moments in the history of the entertainment business where companies have said, you know, this is going to be the time that we improve diversity and improve representation on screen. Those efforts have produced marginal gains. You certainly have more female directors and directors of color, more TV shows and movies about people of color and with women in leading roles than you did before, but nothing close to kind of mirroring the numbers in traditional society, and that's especially a problem in the executive suites. Most of the people that I speak with feel that there is more momentum behind change right now, but the issue is that most of the key decision makers are still white men who are maybe not inclined to rock the boat as much as the people who work for them would like to. So I think it's going to be really interesting to see what happens over the next couple of weeks, months, and years, and whether this movement that has very much swept across America kind of has the effect that people would like to see in the film and television, which informs how so many of us view race and our fellow citizens.
Bloomberg's Lucas Shaw, thank you as always for breaking it down for us. Now, shareholders of the German industrial manufacturing giant Siemens approved today a spinoff of its energy business. This comes despite recent tumultuous months for both the oil and the gas industry. Bloomberg's Anna Edwards and Matt Miller spoke to Siemens CEO Joe Kaeser ahead of the company's voting.
The reason why we do the spinoff is that we believe that focusing our company is very relevant in unprecedented times of change and speed of change. We have done that very successfully 2 years ago with Siemens Healthineers. We brought them to the market at 28 billion market cap. Today they are at 43 billion market cap. So massive value creation through focus and re-rating. The similar matter we do now with splitting our Siemens AG company into the industrial software automation company, including infrastructure, as well as the Siemens Energy. So this is not about Siemens Energy to the market. This is also about de-risking the new Siemens AG, focus it on industrial automation, digital twin, software, infrastructure, and modern mobility. So this is also, a two-pronged approach. Now coming to Siemens Energy, as I said, about a 30 billion euro company, 90,000 people. That's a restructuring story. There's a lot of overcapacity in the traditional energy generation market, including transmission. Of course, also oil and gas, which is a minor topic in our equation.
Is there no oil price, no very weak oil price, that will stop you from doing this at the end of September?
Yeah, as I said, the oil price really is not relevant to the equity story. The relevance of the equity story here is, first of all, it's a restructuring case. We need to right-size the fossil energy area. But the real equity story is about transforming the Siemens Energy from traditional fossil energy generation into renewable energy. As you know, we have a 67% stake on Siemens Gamesa Renewable Energy, one of the two largest renewable energy companies in the world. That's the future. And what we are doing now is to transform the traditional generation into renewable energy, and using the grid piece, the connectivity, which becomes more and more relevant in the multi-generation environment as the transmission and smart grid field. So we're very confident about this move. We do not need capital markets let's say, sentiment for that, because it's a spin-off. We'll be spinning off 55%. We deconsolidate the Siemens Energy from Siemens AG, de-risk it with that. So I believe the single biggest potential on that move, which we are hopefully going to be approved today, will be a potential re-rating of the new Siemens AG rather than the energy field going forward.
That was Joe Kaeser, CEO of Siemens. And coming up, Uber setting out a path to profitability, expanding further into food delivery with an acquisition of POSTMATES. But will the billion-dollar deal deliver? More ahead with Steve Zhang. He's the founder of Kindred Ventures and an early investor in both Uber and POSTMATES. This is Bloomberg. Uber is trying to achieve that long-awaited, elusive profitability. They're announcing plans to acquire the food delivery rival POSTMATES for about $2.65 billion. Some are welcoming the consolidation as a means to limit losses, while others expect an Uber-POSTMATES merger to now draw some antitrust scrutiny. Joining us now is Steve Zhang. He's the founder and managing partner of Kindred Ventures, and he was an early investor in both Uber and POSTMATES. So, Steve, great to get your perspective on this. And I'm really curious, this market was desperate for consolidation. Is this the right deal, even though POSTMATES maybe wasn't a big competitor? I guess you just want to take out a competitor and consolidate in any way you can?
Sure. Hi, thanks for having me back on the show. I think the important thing to note here is that these two companies have competed against each other for better part of a decade. POSTMATES started out as a courier API, in fact, and wasn't food focused. Uber Eats came into the market well after Uber ride sharing did, and there were early acquisition talks actually about merging the two companies about 4 years ago. And I think at that time, Uber Eats was seeing hypergrowth as a new business subsidiary within Uber on the Uber platform. And so it just didn't come together at the time. But what POSTMATES has done well over the years is really build a strong brand with their customers and in the market. And so even though it's number 3 in the marketplace in terms of delivery service companies, they offer key advantages in certain key markets like Los Angeles, and offer a market share gap closure for Uber Eats to get from number 2 to close to number 1. An important thing to note too is that POSTMATES has done a lot on the API side originally as a courier company. And so the POSTMATES API service is well used by a lot of companies across the nation as the last mile fulfillment for their consumer packaged goods and food. And so in this time of COVID, POSTMATES has done a great job of providing what's true to their service. And then with the combined merger with Uber, what we think will happen is that POSTMATES will stay independent as a brand, but they'll share resources and join the Uber marketplace platform, which should provide, commingling all the service drivers as well as all the technology backend to improve a lot of the data analytics that both companies have been investing.
Steve, what does this mean for the industry and the consumers as you have Just Eat Takeaway with Grub, Uber with Postmates? Do prices go up?
I think Grubhub, with Grubhub, the thing to note is that that was a food delivery company, but it did not provide the actual delivery, the logistics. And so Postmates is actually number 3 in the market in terms of offering both a menu and a network of restaurants and order functionality, but also a network of delivery couriers. And so I think what's important to note here is that what it does is creates consolidation in a market which is highly competitive. People are fighting for drivers. People are fighting for the attention and exclusivity with restaurants. And I think that with consolidation, I think a lot of the marketing expenses and cost of acquisition should be improved across the system, not just with Uber and Postmates as a combined entity, but also for all the competitors. So I think it's an overall great thing for the food delivery service industry.
Steve, you're a big investor. What opportunities are you now seeing that have been disrupted and some fresh opportunities that are coming about due to the pandemic?
We're seeing, COVID has created compression across society and the economy. And in that compression, we've seen, a lot of concerning things, but then a lot of interesting notions and insights. So if I were to pick 3 areas where we're seeing a fair amount of new insight, it would be health and wellness. It would be in e-commerce and marketplace services, which we just discussed, and also in infrastructure software, in the future of how we're going to work as an economy, whether it's in offices or in factories. On the first point, the idea of health and wellness used to be going to the hospital and going to wait for a doctor and get an appointment and then get your prescription. And these days, at-home care through virtual care, telemedicine, has inverted the entire system. We were on a video conference with a health system, a CEO of a major health system in the United States, and they said that their 5% of their visits with patients were telemedicine pre-COVID. During COVID, it's been 95%. So it's completely inverted because of the pressure that it's created on these health systems. And so we have a company in our portfolio called Heartbeat Health, which is providing heart health, cardiology, as a virtual care service, connecting cardiologists around the country with their patients directly. And they've seen tremendous growth, recently announcing a partnership with American College of Cardiology. In the software space, we've seen a ton of pressure both on infrastructure as well as communication and collaboration software. You've seen that with Zoom, Slack, Microsoft Teams, and we continue to see a lot of startups in our space really seeing 5 to 10x demand for various software applications that will allow their teams to be distributed. The future of how we're going to work is going to change. One is we're pushing for a distributed workforce. It's forcing us to put everything in the cloud, and you're seeing that with the rise of companies like Five9 and AWS seeing maximum demand. We've actually been hearing that GCP, AWS, and even Azure are running out of capacity and scrambling to figure that out. And we've been hearing that from a lot of startups in our portfolio. And so I think there's some telling signs.
Yeah, I just wanted to follow up on that note quickly here. It's interesting. I was surprised by this. As you talk to some of your portfolio of companies and within your space, companies that have IPO'd recently are actually outperforming the S&P 500, indicating that it actually might be a good time to go public, as crazy as that sounds in the middle of a pandemic. Are you talking to companies about if now actually could be a good time to be going public versus staying private?
Yeah, I think that what's happening right now is that a lot of these technology companies provide a solution for our situation. Now, these were great solutions before COVID, but during COVID, what it's really done is sort of shone a light on what is a way to be able to operate as a company or as a business or as an industry even as just an individual human being. And so a lot of these communication collaboration workflow companies, if they're seeing increased demand, going public right now, whether it's direct listing or IPO, makes a lot of sense. The capital needs to find great investments in this time of great volatility. And what we're seeing right now is not only increased demand. I mean, one of our companies is Tonal, which is a at-home connected fitness company. They've seen over 400 or 500% growth in demand year over year, just like Peloton has. And so if you look at the Peloton IPO from last year and you watch their performance through this year, you can see that that spike in demand, and that's going from the individual side at home all the way to the company and corporation. And so I do think that it's strangely, paradoxically, a interesting time for a technology company that is a solution, that brings a solution to market that is much needed. It is an interesting time for them to go public.
Yeah, well, an interesting time, and all of your thoughts on connected fitness, fascinating as well in this COVID area. Thank you, as always, to Steve Zhang. He's the founder and managing partner of Kindred Ventures. And stay with us, because still ahead is criticism and threats of banning mount. TikTok's parent company is now looking to distance itself and distance the app from its Chinese roots. We will have that story next. This is Bloomberg. ByteDance says it is evaluating changes to the corporate structure of its TikTok business. This is all as U.S. concerns are growing over the parent company's Chinese origins. Joining us now to discuss the structural changes is Bloomberg's Shelley Banjo, who's been covering the company for us. Shelley, there were some reports floating out there earlier, and I'm curious what you think a corporate structure change, spinoff, what that would achieve.
Yeah, definitely. So ByteDance said it's going to evaluate changes to its corporate structure and also think about creating a global headquarters for its TikTok business. And so these are all a continued effort that TikTok has been doing over the last couple of years, actually, as to try to establish itself not as a Chinese company, but a U.S. company or a global company.
Shelley, I'm curious how much of this is coming due to increased calls, at least here in the U.S. I was speaking with a senator yesterday who had created a bipartisan legislation called banning TikTok on some government devices. How much of this is response to growing pressure here in the U.S. that more, at least people within government, don't want that app in the U.S.?
Yeah, so this whole move kind of started with congressional members, and so they were really the ones pushing for this. We didn't really hear from the administration until this week when Secretary of State Pompeo and President Trump came out and floated a possible ban of the app. Now, it looks like an actual ban of the app would be something difficult to carry out, but the sentiment is still there, which is that the administration has kind of moved closer to the hawkish tone of a lot of the Republican senators. And the reason of that is because it seems to be working in terms of, post-coronavirus, post-pandemic, kind of having someone to blame in China. And kind of any company falls into that. Huawei is one of the other kind of targets that the Trump administration has gone after.
Shelley and I misspoke earlier, so I'm going to do a B-Tech correction here. I meant to say a Congressman, Ken Buck of Colorado, was who I was speaking with yesterday. On that note, as we talk about a company with no global headquarters, is that intentional? What would a global headquarters look like to you, and where?
Yeah, so right now in every story that you read, it will say, like, TikTok is owned by ByteDance, a Chinese tech company, a big Chinese conglomerate. And I think what they're trying to achieve is trying to kind of recategorize TikTok as a U.S. company. So they hired Kevin Mayer from Disney to be their CEO. And you've seen since that hiring in every kind of statement that the company has made, they've kind of trotted him out. You know, we have the CEO, he lives in Los Angeles, and this is an American company. They're boosting their staff around the country, but also in Washington, and creating these kind of transparency centers, they call it, where they're inviting lawmakers and policymakers to kind of come in and see. And I think it's part of a larger ambition to say, we have nothing to hide. We're going to place a stake in the ground and say, we're not part of the Chinese government, and we're a social media company, and we're trying to make money just like everybody else.
Yep, Bloomberg Shelley Banjo covering all things TikTok. And that does it for this edition of Bloomberg Technology. Reminder, we're live streaming on Twitter @Technology on Twitter. This is Bloomberg.